So thanks a lot for joining. I will, we can do our Q&A towards the end of this session. Basically, let me just run you through what I believe about the market and what are our, what is our future course of action given that the market has already run up a lot. Moving ahead, I'll just quickly cover our performance. Now, the performance that you see here is since we started. So as you all know, your individual performances might be very different from this because of the date and time that you started, also because capital came in at different points of time. Versus what small case does is it assumes 100 rupees was invested on day zero, and then there's no incremental capital coming. So yeah, this is quickly our small case performance over the last 2 years. Technofund has delivered 60%. VC investors portfolio, which is our small and micro cap basket, has done close to about 52%. Technofunda, on the other hand, is more of a high churn portfolio, whereas VC investors portfolio is less churn, small and micro cap stocks that we believe will become multi-baggers of the future. So more or less, I think we've done quite decently better than the index. In both the cases, we've beaten the index by a decent margin. Now let's look at what the index has done. Both Nifty 50 and Nifty 500. Although we like to benchmark ourselves against the Nifty 500, but if you look at the Nifty 50 over the last 1 year, it has almost given 21.3% returns, whereas Nifty 500 has done much better. It has given 33.55% returns, right? And so this is the large cap basket, and this is the large plus 450 odd companies, which you can say is the flexi cap basket for us. And we like to compare ourselves with the index. So just for comparison's sake, if your mutual funds have delivered anything between 30 to 35%, all they have done is basically meet the index returns, right? Because the index itself has given 33, 34 odd percent returns over the last 1 year from a comparison point of view. And hence, and that is how you should benchmark our returns also, that if over the last years we've not been able to give 35% returns, that means you've not been able to beat the index. As simple as that. Now, large caps during this period have not done as well as the small and mid caps. And some people, very well-known people, went on to say that small and mid caps had frothy valuations. So we'll come to that later. But the earnings growth delivered by large cap stocks have been something close to about 21%, whereas 31% for mid cap stocks and 48% for small cap stocks. So as you can see during this period, the small and the mid cap basket did much better in terms of earnings growth versus, let's say, large cap stocks, right? And even in Q3 of FY24, the PAT growth for the entire BSE 500 stocks was 25.5% year on year, versus in case of Nifty, it was just 16.3%. So there is a very valid reason why the large cap stocks have not performed, and why the mid and small index has done almost 50% better than the Nifty 50 index, right? So it's all comes down to the fundamental performance and the earnings of the Nifty 500 companies. And if you do a comparison versus let's say pre-COVID in the year 2020. So just to give you some context, Nifty, the top 450 companies after the Nifty 50, if you look at the other 450 companies, their earnings put together were in the range of almost 60,000 crores, the PAT for all the companies combined. Whereas if you look at FY 2024, that number is almost 7 lakh crores. So the earnings have increased by almost 10 times during this period, right? And it is in this context that the index also has, the small and mid cap index has also done much better than the large cap index. Now after this bull run has happened, let us try and understand whether can we say that the market is overvalued right now or not, right? So what you're seeing here is the Nifty 50 index. This is not Nifty 500, but this is Nifty 50. So let's just look at Nifty 50. And what you will see is that this yellow line is, of course, the Nifty 50 index. And this blue line is the PE ratio. So as you can see here, that during COVID, the PE peaked all the way up to 42 because the earnings were not so much, but the prices were very high. And even from COVID levels, right from 2020 to 2020 onwards, the PE ratio has corrected and now stands at 21.4, whereas the market is at all-time high, right? And all of this is just because the earnings caught up. The earnings of Nifty 50 companies, they increased, and hence there was a correction in the PE ratio. And even during this time, the markets kept rising. So if you look at the PE indicator, which is 21.4 right now, is not excessively in the overvalued zone, right? So even when the markets are at all-time high right now, we cannot say that the markets are overvalued, because from a price to earnings ratio point of view, we're still in the green zone, as you can see here, right? And the lifetime average is something close to 20.72. So the 20.72 average, we are very similar to that number, as you can see right now. So Nifty 50 in that sense is nowhere overvalued, right? And like I mentioned to you, the growth in the small and mid cap index, what we discussed was Nifty 50. Now let's look at Nifty 500. Now Nifty 500, if you look at the index was at 7,010 March 18, 2020, and the EPS was at 317. Now if you look at May 30, 2024, Nifty is almost 21,000, which is just 3x of what it was. But if you look at the EPS has also grown, right? So to say that, valuations are frothy is completely untrue in my opinion, because all of this is backed by very strong performance in terms of earnings growth by all these small and mid cap stocks, right? So in no way can we say that the returns and the index are at frothy valuations. If you look in terms of price to earnings still for the Nifty 500 index is something close to, I think, 23, 24 price to earnings ratio, right? So yeah, it is slightly premium because there's a lot of growth, but in no way can one say that it is very overvalued. Also, I think going into the future, I do believe that the small and mid cap index or the small and mid cap stocks, these 450 stocks that come after the Nifty 50, they will keep performing in terms of their earnings growth, because they have done a lot of capex. That capex is going to result in more revenues and higher profitability. So in my view, for the next 2-3 years, we are going to see this small and mid cap rally with intermediate corrections in between, right? I think that situation will continue. And if you notice, this green line is the EPS growth line, and the pink line is the movement of the index. So in fact, movement of the index trails the EPS growth, which means EPS growth is coming, and then there is movement in the index, right? So in no ways are we seeing that the valuations are running faster than the growth of the profitability of these companies, right? So in a way, to me, it is all earnings growth. Everything is earnings growth. The rise in the small and mid cap index can be completely justified by the increase in profitability, the growth in profitability of the companies that form this index, right? And in contrast, if you see, the large cap stocks have not done as well. For example, the large caps have given just a CAGR of 16%, right? And hence the underperformance from that point of view. So, and I think in a growing market, for example, if you're looking at a country where, for example, India now did grow at 8.2% last year. So when the country starts growing fast, it is generally the small and mid cap index or the small and mid cap company that starts to do very well, right? And as long as that continues, I think there is no reason for us to worry that small and mid cap index is at frothy valuations. In no way, I think that's true. Now, as I think yesterday only this data came out that India did 8.2% in FY 23-24, and going forward, as per RBI estimates, that number is about to be 7% in FY 25, right? So if you look at the flow of slides that I'm discussing, what I'm only saying is that over the last 2-3 years, the index has done very well, especially Nifty 50, Nifty 500 has done well than Nifty 50. All of this is backed by strong fundamentals from the underlying companies in terms of their profit growth. And to me, there is no froth in the valuations that we are at right now, at the level that the index is right now. It is all supported by very strong fundamentals, and generally in an environment where you have high growth rate. I think India did 8.2% after a very long period of time, because we fell to 6.5%, I think, during the 2018, 2019 times, and even during COVID. And I think post-COVID, this growth has increased. So in times of such high growth where, you're looking to do more than 7% CAGR growth, a majority of that growth rate will come not from the top 50 companies, but from the next 450 to 500 odd companies. And that's where majority of the wealth creation will happen, as long as we have a relatively high growth rate. So for us, it's important to stay invested in these small and mid cap indexes companies as long as there is healthy growth, as long as there is visibility of healthy growth, and as long as these companies continue to perform quarter on quarter. I think there is no need to worry from a valuation point of view, irrespective of whether the index is at all-time high or not. Right now, now that we are at all-time high, in fact, the Nifty 500 has been touching all-time high ever since the last 7-8 months. So it's always a new all-time high. But in my opinion, after the election results are announced, and hopefully, market is wanting that there is a continuity of the government because of the policies that they have implemented. So I think the market is expecting that there has to be a continuity, which is why it will be a good for the markets if BJP comes back to power. Otherwise, if BJP doesn't come back to power, then we might see a very sharp correction. Although yesterday, the way the Adani stocks rose, I don't think. I think what the exit polls will tell is that BJP will gain majority. Now, one might question whether it will be 370 plus 30 or it will be 300 plus 50 or whatever that number is. But I think there is a general consensus among all the investors that BJP is coming back to power, right? And if that's the case, in my view, all the positive news is already priced in, right? The market where it is at right now, the growth that we are about to see in terms of the entire economy, the that BJP will continue for the next 5 years as the central government. I think all of that is completely priced in terms of the current valuation, right? Now, from here, if the market has to keep going up, it has to be completely supported by the corporate earnings growth only, right? So this is the only factor which can lead to future performance of the index and Nifty 500 to be particular, right? Because all of these other things are priced in. The fact that India is growing at a great pace, the fact that BJP will continue, all of that is priced in at the current level of the market. And maybe on 4th May, you might see the market making a new all-time high. But then in my opinion, there are a lot of negatives which are not currently priced in. And these negatives might come as a surprise to the market over the next 5 to 6 months. I'm not saying this is going to happen immediately just after elections, but over the next 5-6 months, right from till the way all up to December. Sorry, can everybody please go on mute? Right. So what I think is that from here on, there are quite a lot of negatives that can affect our markets, and mostly the external negative. This has nothing to do with the internal economy and the companies that we're invested in, but mostly because of the external factors. And you've seen that over the last 3-4 months, the Iran-Israel war and some of these other geopolitical issues have influenced the market from time to time, right? And I think those continue to be major risks going forward as well. Risk in the sense that they might trigger a serious correction in the market. When I say serious correction, it can be anywhere from 15 to 25%. So the broader market can correct from 15 to 25% because of all of these reasons or one of these reasons as well, right? So there are high chances that US will go into a recession starting next year and I'll talk about that later, but inflation there is not under control, right? And even though they've kept the interest rates high, inflation is not coming down. In fact, if we look at, so I'll go to the next slide. In fact, if you look at the inflation data right from July onwards, July, August, September is when it formed this low, I think 3.2%. But since then, it has maintained this range and it doesn't seem to be going down. Now, the risk here is that if US goes ahead and does a rate cut, then this problem will increase even more, which means that inflation will go past this number and I think it will come back to 7-8 odd levels, which again is a problem. So it's good that US is not cutting rates, but even with US not cutting rates, because inflation is consistently so high, I think what might happen is that by that next year, we might see a couple of banks, declare bankruptcy. And the reason is this: for example, for a very long period of time, almost 13 to 15 years, they had almost a zero interest regime, right? So they were borrowing at 0.5 to 1%, maybe even less than that. And now these interest rates have gone anywhere from 5 to 6%. So just for example, in the case of housing loans, if you see, somebody who was paying a 5% mortgage rate is now paying 5.5% is now paying 5%, which means 10 times the interest. Now, nobody had done this maths when they were taking this home loan, right? In an economy where people generally don't save money. So, and this has been high for quite a while now, and I think going into next year, more and more people will start defaulting on their home loans, which means one can expect that by early next year or next year, one can start to see housing crisis begin again, because a lot of these people who cannot service their debt at 5% will start defaulting on their home loans. And because of these high US inflation, what all of these central banks are doing is that they are buying gold. So if you look at India, if you look at China, if you look at Turkey, none of these central banks today want to hold the US dollar, because they all know that, US dollar is depreciating at a great pace. 5.5-6% for US dollar is very high inflation. So they all want to shift to gold, which is why gold is at all-time high right now. And I think as there is more clarity on US getting into recession by next year, what will happen is that gold prices will keep inching higher. So I don't see gold prices going down anytime soon. In fact, they have to keep going up, because to be honest, US has not even declared that they are in a recession right now. And the more and more, if you look at the numbers and the way inflation data is coming, it doesn't seem like a rate cut is anywhere around the corner, right? So, and these central banks are very smart, right? They know what is really happening, and that is why they are, selling US dollar and moving all of that to gold. So one thing is for sure, like I said, that seems almost like something that is inevitable to happen, is that US will go into a recession. Now we don't know if it will happen by the start of FY25 or it will happen by the end of 25, but sometime next year or so, there are very high chances that US will go into a recession, and inflation will continue to stay high, and there are no rate cuts coming, right? These are some things that I believe will definitely happen. It is very, unlikely, something there is wrong. If you look at the markets right now, gold is at all-time high, and S&P is also at all-time high. Now, rarely does that happen, that gold and S&P, both these indexes remain at all-time high, because they are hedges to each other. So either one of them is wrong. Either gold is wrong or either S&P is wrong. And in my opinion, it is the S&P which is at very high valuations right now, and there is a sharp correction that is expected once US goes into a recession. So I'll briefly cover what I intend to say. In my opinion, S&P is at its all-time peak. The current value is something close to about 5,277. And here what I've shown is I've shown a 19, almost, this chart is almost from 1899 all the way up to 2024. What you will see is that I have joined this line below. Yeah, so what I've done here is I have joined all these peaks all the way from Great Depression to the dot-com bubble, right? And I want to talk about a couple of phases where the S&P underperformed significantly for a very long period of time. For example, we had the Great Depression in 1929, and it almost took for the S&P to recover. It did it in 1953. After almost a 20-year period, S&P recovered during the Great Depression. Then I want to highlight this period where US was in high inflation environment. So their interest rates went all the way up to 10 to 14%, I think. And then there was a Fed chairman who had to increase rates all the way up to 25% to bring inflation down, right? So if you look here, right from 1970 all the way up to 1980-82, the S&P index underperformed. And then we had a huge bull run, which led up to the dot-com bubble. Now, dot-com bubble and 2008 financial crisis, they had the same peak. So, to be honest, from 2000 to 2013, almost 13 years it took for S&P to recover the 2000 odd levels, right? And now, if you look at, we are at the 5,277 level, which is very close to this peak. So, for S&P to touch this line or get closer to the line is very risky, because this is a all-time high resistance line. And in my view, whenever it touches this line, it goes into a consolidation for a long period of time. So this is quite, this funda quite matches with what is happening fundamentally in terms of their economy, because they have very high debt levels, they have very high inflation, They might see a housing crisis very soon. And so logically, it makes sense for the S&P. So anywhere between 6,000 to 6,500 range, I believe the S&P to peak out. And that's when US will start to get into a recession. And the immediate impact of that will be that Indian markets will also start correcting because India and US are so much connected. Now, the good thing about Indian markets is that over the last 4 or 5 years, we have seen a lot of domestic retail investors enter the market. So the domestic today is very, very strong. In fact, the last couple of times FIS did selling, Indian investors, they came forward and supported the market, right? And I think from that point of view, our markets are much more resilient right now. But nonetheless, when US goes into a recession, we will also see some correction in Indian markets. And which is why I think these times are very critical and quite, to be honest, one needs to have a very cautionary and a cautious approach to the markets right now. Because to be honest, after the Indian elections, there is nothing new or there's nothing very positive that we are about to see, at least in the Indian markets. But all of these things that are happening outside of India in terms of US, in terms of Europe, for example, is into recession already. UK has been seeing its growth rates go down for the last couple of quarters, right? So that's their major challenge. And I think we might see S&P underperforming for the next 4 to 5 years. At least this decade, I believe that S&P will be an underperformer. Right, so it makes sense that we become very cautious because we've made whatever capital that we've made over the last 3 4 years. I think that's now important to protect that capital. I think we've done a relatively good 50-60%. In some cases, we've also doubled the portfolio. So it's important that we protect that capital and make sure that we hedge our positions both against Indian and US equities in a way that we are protecting capital while also making sure that it is growing respectfully. And try and avoid situations where we have to go through a significant market correction right now, right? Although, so that is basically why I believe that there is a lot of negative news that might come from outside of India. Now, for us as Indians, our equity story is intact. I mean, whatever I told you right now is just a short-term correction that we might see, which can be anywhere from 2 months to 5 months, 6 months. I don't know. It can be a slightly long, or it can be just for about a month or two. I don't know. We'll have to see how it happens. But at some point of time, the bad news from US will start to affect India, right? And so it's important to look at what are the options right now where whatever capital that we've built over the last few years, how do we protect that capital? How do we make sure that it keeps growing? And how do we hedge our positions against Indian equities? Now, this in the context of the fact that we are growing fast as an economy. Our small and mid cap companies are doing well. Even the large caps are doing okay, but small and mid cap companies are really doing well. So it is in that context, I believe that what we should try and do right now is maybe liquidate some of our portfolio, right? So let's say if you have 100 rupees deployed, I think what we should do is book some of our profits. I'll come to where we should book our profits, but we should at this point of time try to keep some cash so that once the market corrects and once the news that US is in a recession is discounted, then after that, I think it will be a good time to redeploy capital back into Indian equities, because after that, I think India might be again ready for a recovery in the broader markets, right? So that's the thesis. And in all this, what we're seeing is now we started looking at hedge case. How do we hedge our position in Indian equities, and also how do we hedge for the fact that inflation is high in US? So we started looking at China, and China apparently did not do well for the last 4 or 5 years, but it is starting to do well. So the growth in Chinese economy is better than expected. In fact, the IMF has increased the forecast for for growth rate of GDP of China, which is now 5%. Now, for the kind of economy that China is, it growing at 5% is a huge number, right? And I think that will start to affect their economy, their markets as well. So, in my view, when I started looking at the technicals also, because as you all know, we follow the techno-funda approach, right? So all the fundamental gyan that we read and study has in some way to be seen in the technical charts also. right? And that is where we build a lot of conviction that, the fundamentals are actually seen in the charts also. So if you see right now, this is the SSE composite index, which is the Shanghai Stock Exchange. This is the composite index, which since 2007 has been consolidating, right? And we are very close to this breakout. As you can see, the point where these two lines converge, there is very high probability, given that they're already delivering high GDP growth rate, that this might break out in the positive direction. And we are very close to that breakout, in my opinion. Now, the Indian exposure to that is through an instrument called ETF Hang Seng Bees, which is the Hong Kong Stock Exchange. And as you can see here, there is a breakout already, right? So this breakout has already happened, and it has happened with huge volumes. You can see the volume also in the lower portion of this chart, right? What it means, and this is my thesis, is that China for the next 4 or 5 years will deliver very good growth rate for the economy and the kind of economy that they are. And although India might see some short-term correction, and like I said, this correction can be anywhere from 2 months to 6 months. We don't know, but whenever we are through that correction, we should deploy that money back to Indian equities. But during that period of time, I think China provides a very good hedge against India and US put together, because India and US are so connected. That anything that affects anything that affects US significantly affects India also, right? So just from diversification point of view, it is good to have a third economy in your portfolio in the form of the Hang Seng Index, right? And this index, by the way, is expected to do well. So this is not just protection, but capital growth also, right? In my view, and this is similar to the trade that we took maybe 1.5 months ago, when I asked all of you to please invest in silver bees. And as you can see right now, silver bees is already 10 to 12% up from the levels that we bought, right? So in my view, it is a very good option right now to take exposure to China, reduce some exposure to India, obviously reduce some exposure to US. And US is expected to see elections by November. So the existing government will try to keep that narrative that we will cut interest rates and inflation is under control and the economy is doing extremely well, right? So this is just the election agenda, that they will try to push down the story that everything is very hunky dory in US, but to be honest, it's not. And the S&P and the MAFANG that you're seeing today, I mean, if you look at the way the S&P index and the MAFANG index is going up every day, it is almost scary, because there is very little reason for S&P to just keep going up, the way it is going up, right? So obviously, US markets is not acknowledging the fact that they are about to see a huge housing crisis, or that rate cuts are not coming. So, I think it's going to come as a surprise to them also, because to be honest, last time when the inflation number was 0.1% less, the markets went up, thinking that rate cuts will happen. But I don't think these rate cuts are coming, right? So just the way these markets are connected, India and US, I think it's just a good idea to have a third economy also in your portfolio, which is the Chinese economy, which, by the way, is expected to do very well over the next 2-3 years, if not less. And if you look at the metal rally right now, it is all because of China. China is investing so much into their economy in terms of infrastructure, in terms of electric vehicles, in terms of steel, aluminium, and all that, that they have driven the metal prices to all-time high. And if you would know, we have taken exposure to metals. We did that about 4 months ago, and I think we are good 20-25% in the profit right now. So what we are doing as a strategy, that we are thinking of, or in fact, we've already over the last week, we've sold some of our cyclical bets, right? So as a strategy, we are selling our cyclical bets. We are not selling our high conviction long-term bets. For example, Suzlon, we are not selling. Sterling and Wilson Solar, we are not selling. Any exposure to, for example, recycling stock, Gravita India, we are not selling, because these are 10 to 15 year long bets. So we will not sell them just because we foresee a small correction in the Indian markets. But something like cyclical bets, for example, bets related to metals, bet related to infra, some of those bets we thought this might be a good time to liquidate and book some profits there and keep the cash, or move the cash to Hang Seng Bees or gold bees or silver bees, where we believe that the capital will be protected and the capital will grow. And once the Indian markets have corrected, then we can deploy that capital back to Indian equities, right? So a lot of people have come back to me and said that, we have some additional cash to deploy. But my request would be, please hold that cash, or we can deploy that cash in one of these three instruments, which is the gold bees, silver bees, and the Hang Seng bees, because I think just because inflation is so high in US, these two instruments are a very good hedge uh, to Indian as well as US equities. And in my opinion, these gold and silver prices will keep going up into the next year as well. And the reason why metal stocks are also high is also because of high commodity prices. High commodity prices are a consequence of high inflation in US. Of course, there is high demand coming from China, but it's also a consequence of high inflation in US. Right. So these are the three instruments that I wanted to discuss. As a hedge, we can use these three instruments. We can liquidate some part of our portfolio, mostly cyclical bets, not the long-term bets, and keep some of that as cash. And we can also deploy them in these three instruments that I discussed, because this is where I believe we will protect our capital going forward. Also, we will grow our capital, right? And it provides a good hedge to our portfolio also. Adding a new geography altogether, plus adding gold and silver, which are the ultimate go-to investment products in times of crisis. Now, if there is any bad news on US, for example, going into a recession, then these two assets will keep going up. There is no doubt about it. And the way it has gone up already, and the way central banks are buying it, and the way a lot of big investors are lapping up gold and silver, I mean, you can see the increase in volume, right? That is the reason why I'm seeing a lot of big institutional investors are starting to buy gold and silver bees, is because you can see the ramp up in volume, and all of these can be justified by the fact that inflation continues to be high in US, and it doesn't look like going down right now. Right, and all these central banks are hedging their positions against US. So they are cut. So India, for example, is holding the lowest US dollar reserves right now. Similarly, China has sold a lot of its US dollar reserves and moved that capital to gold. Right, Turkey has done that, and a lot of emerging economies are doing that just to protect themselves from any such unlikely event happening in US. Because if, let's say, US goes into a recession and our central banks keep holding US dollar as a lot of US dollar currency, then obviously the effect of that will come to us as well. So it's a good way to protect our economy from the fall in US economy, right? That way. So I try and basically conclude what I wanted to say. Firstly, we are bullish on India, right? And valuations are not too high. And going forward, small and mid cap stocks will continue to drive our markets. The earnings growth will continue to drive our markets upwards. However, I believe that in the short term, for the short term, next maybe 2 to 6 months, all the positive news has been already captured. And I think there's a potential for a lot of negative news hitting the Indian markets. And mostly that news will come from US, right? So how do we protect our portfolio? How do we protect the capital that we've built over the last 2, 3 years in COVID? After COVID, the bull run that we enjoyed so consistently is that we liquidate a part of our portfolio and we move some of that to the Chinese economy. We take some exposure to China, we take some exposure to gold and silver, but even doing this while we keep holding our high conviction bets like Gravitas, who's launched, Sterling and Wilson, banks, for example, Yes Bank, Doubles Housing Finance, and Doubles Real Estate. These are our high conviction bets, and we will use the cash generated either to keep it as cash or to hedge our positions by investing in these three instruments like I discussed. And once Indian market has discounted the fact that US is in a recession, which might take some time, right? So once we have discounted and the news is completely in, and the markets have discounted the fact that US will be in a recession, I think it is at that point of time that we should take a call of again moving back to Indian equities. But I think even all during this time, my sense is that the small and mid cap stocks will keep delivering in terms of numbers, right? And that sort of comfort will be very good to have and very good to track, even while US reports high inflation numbers and the fact that the economy is going into a recession. Even during those times, I think it will be good to keep tracking the performance of the small and mid cap universe that we are tracking right now, right? What we might also do is basically move some of our exposure to large cap, because large cap there are a couple of good bets in large cap right now. Additionally, in addition to China, gold and silver, we might move some of our positions to large caps where we believe that the opportunities are good right now, right? For example, metal large caps in the metal sector are really a good opportunity. Large caps in the pharma sector are a good opportunity. So in sectors which are doing well, which include, let's say, metals, pharma, auto did well till date, but I think auto cycle has peaked right now. So I think we've advised all our clients to exit the auto space. But some of these sectors continue to do well. Infra, real estate, these sectors will do well, right? And it makes sense to pick some of the large cap stocks within this space so that we are not so much affected by the volatility in the short term, and we continue to be in the right space, and we continue to be in large cap stocks within that space, right? So that way, I think we will be able to hedge our portfolio against a possible downfall in the market. And yeah, so that is what I wanted to cover. Happy to answer any questions now.